50,000 becomes 1.5 million. Don't you think I will do it? Your account will blow up with 300 pips stop because the market retraced more than 300 pips. You can trust me. Go and see it yourself in the MetaTrader with a daily chart. You can see how many times the market has retraced 300 pips. An example is in December when the market retraced 364 pips. Another one is in April, 2 years ago. The ones who trade in option knows the volatility. The ones who trade on direction doesn't know the volatility. It means how much the market is moving on average. If the market makes 2,000 pips in a month, it can retraces even 1,000 or 400 pips. If the market makes 500 pips in a month, the volatility is low, and maybe it doesn't make 1,000 pips retracement. Maybe, because volatility can change. The volatility shows you what happened before in the market, so please be careful. Volatility can increase tomorrow. So if the volatility increases on euro-dollar even more, the margin rules is not a Bible rules, and the 2,000 pips has to increase. It can be less than 2,000, but not 500, and not less than 1,000. So what's the leverage? One lot is $100,000. This is what counts to know how much I have on my account. When you use a broker, you need to choose which leverage you want. You can take the maximum because for you it's important to know how much you have in the account and how much you can use to go in the market. If you have $100,000 account and one lot, it's $100,000. Your leverage is 1:1. If the broker gives you a 1:100 leverage, which is the market standard, one lot for you is 1%, so $1,000. If you have a $1,000 account, when euro-dollar change 1% against you, your face get purple, your account go in margin call. At that point, the broker closes all your positions because it's not sure if the market will go back in your favor. By the rule, the broker can't go over your margin in your account, so it will take the money you have in your account that guarantee the positions. The broker wants to be assured that this is his interest, to always have the customer's money. So, poof, he closes all positions to avoid that you can lose more than you have. Okay, here we can see one lot, $200 with a leverage 1:500. This is the margin asked by the broker. Obviously, when you buy $100,000, your risk is $100,000, or not exactly, because the currency can't go in zero. Your exposure is $100,000. It's not because you have put $200, so the risk is $200. No, the broker asks you $200 for a $100,000 exposure with a risk that cannot be $200. If I go in the market with a mini lot, it means $10,000 with leverage 1:1. But with the average leverage 1:100, it means $100. So if I have $100 account, I can go in the market because they let me go with $100,000. Imagine with a broker with leverage 1:500 like FX Pro, which is a Formula 1 sponsor, you can go in the market with $20 for $100,000. Okay, how many lots do you want? You have a $1,000 account with a 1:500 leverage. How many lots can you buy? Very simple. So, they ask me, $200 for one lot, I can buy 5 lots, which means they give me 5 lots for my margin. But I go in the market with $500,000 with a $1,000 account. How many pips do you have before the account blows up? 20 pips. You need to know that 20 pips euro-dollar can make them from few seconds to few minutes. In fact, the small account that don't size well the risk can last even less than 1 week. Statistics can prove it. How to size the risk? Your account is your stop. If you put or not the stop loss, your limit is your account. You need to know it. It's like this in option, forex, stocks, futures, etc. All your mistakes correspond maximums to your account. You have a $1,000 account, one lot, leverage 1 to 500, so $200, and 1 pip is $10. So if you go in the market with $200 margin and with one lot, so $100,000, 1 pip is $10. What's happened if you go in short or long? How many pips do you have before the account blows up? Easy. $1,000 divided by $10, so the value of 1 pip. In total you have 100 pips stop. It means that the broker will close your account and ask you to do another money transfer. Because working with $100 pip stop on euro dollar is crazy. You cannot ask how much you need as pip stop. Every time you need to go and see the period volatility, working with or without stop. The euro-dollar exchange is moving with an average range of 140 pips, sometimes more, sometimes less. It means that in one day can change the price for 140 pips. This is the average euro-dollar volatility or daily range, sometimes 120, 130, etc. Do you think to have sized well your risk with 140 pips stop? Risk management. Beginner, but also professional, need to have 2,000-3,000 pips stop. Why? Because when you trade a $5,000 account, you can trade also with 500 or 800 pips. And if you are lucky and clever, you can wait and see. But if you do it as a job, you are not gonna take a higher risk than 2,000-3,000 big pips. I personally trade with 2,000 pips stop. And if I go under 2,000, so 1,700 pips, I do it only for short time and I will recover after my margin. I don't work with 500 pip stop. So if you are a newbie, that's your margin. It's a low risk, intermediate margin, 1,000 pips with medium risk, expert margin 500 pips with a high risk. But this is just for crazy ones. It's like a slot machine. A good risk management is 2,000-3,000 pips margin exposure with a low risk and low leverage. 1 to 2, 1 to 3. For example, with a $50,000 account, you go in the market with 1.5 lot and leverage 1 to 3 with 3,000 pips stop. So risk management, you have a $2,000 account. If you are a beginner with 2,000 pip stop, you go in with 0.1 lot, so $1 per pip. If you are an intermediate with 1,000 pip stop, you go in with 0.2 lot, so $2 per pip. If you are an expert with 500 pip stop, you go in with 0.4 lot, so $4 per pip. How do you do this? If 0.1 lot is $1, you divide $2,000 by 1 and you get 2,000 pip stop. You need to calculate this before trading. I don't go in the market with a number of position open and when the market retraces I calculate my margin. No! I decide before how much margin I need. Compare with the period volatility. After that, I know how many positions I can open. Pips and broker. In the Forex market, people say that there are no commissions. Really? Let's see your broker.